I'm sure we can all agree there are no shortage of topics we can discuss that are influencing the global economy and capital markets. Maybe the best way to go about it is to revert to our baseline expectations, which are for continuation of moderate global growth, low levels of global inflation, and lots of monetary policy accommodation. The Federal Reserve, at the center of that, is trying to weigh strong jobs and income against below-trend GDP or economic growth in the U.S. We side with jobs and income. Whether it's jobs gained, lost, openings, or wages, all rest at 10 to 50-year bests. And GDP is perhaps better inside the numbers, where if we look at the private sector compared to 2002 to 2007, it's a little better. The culprit has been the public sector. Overall, we still think the Federal Reserve is going to be moving up, but doing so at a low and slow basis. But look, maybe the more important narrative is not about central bank decisions, but their waning influence on capital market returns. Recall the great beta trade, something we've talked about a lot, where returns were well above normal, volatility below, and over the next 5 years, those returns would be more modest with higher volatility. Well, for at least the last 20 months, that's exactly what we've seen. Take a look at the S&P price level. Lots of movement, but not a lot of gain. Even high yield, an area that we talked about, had great potential coming into the year because spreads were elevated courtesy of energy debt and other developments, has done very, very well, and spreads are at the place they were about 20 months ago. Which leads me to a big question. Should I be getting out of my high yield today? Not so fast, because if I compare it to expected equity returns, they're about the same versus yield to worst. And so we continue to supplement your equity exposure with high yield, but again, be selective, because the story's inside the story. There's a lot of distribution and yield across the spectrum. Most of the yielders fall below average. Itching for a little more yield like the rest of the world, you've got to move to that far spike. But it means you have to be really selective in your search for yield. And speaking of the search for yield, let's talk about equities. Look at where all the money has gone over the last 3 years. Look, when a lot of flows go to one part of the market, relative valuations are sure to follow, and that's what we've seen. Even in the first half of this year, the best dividend yielders have been the best performers. But let's do an exercise just for fun, shall we? Let's reverse the list so it's earnings growth instead. It literally turns upside down. And that's interesting because we should be looking for growth, particularly in a growth-challenged world. Well, at least for the last 3 months, performance has started to align with these growth levels. And the good news for all of us as investors is, unlike high dividend yielders, growth is actually relatively cheap today as we go out and try to find opportunities. Oh, and speaking of opportunities, the emerging markets are another hot topic. I'm asked about this all the time, and there are lots of things we could discuss, but the short version is economic growth overall, with still lots of challenges, has started to stabilize. Earnings growth has responded in kind, and markets have rewarded it with higher PEs relative to developed markets, and we see that in the returns of the stocks as well as the bonds. The good news for investors, still room to grow because valuations remain at relatively attractive levels. But we would tell you that maybe something you should think about is combining stocks and bonds in your emerging market allocation, because literally the value proposition will vary country by country. Look, I think it's no surprise that the big theme that you're going to hear from us is talking about being active in the coming years, because look, part of the beta trade was greater returns with lower volatility, but the other part was highly reduced alpha potential, or the value we could add through active management. The best way to show this is a way we introduced last quarter. For 40 years, average dispersion amongst returns in the United States was about 30. Below 20 is incredibly alpha challenged. And it's also incredibly rare. From 1980 to 2005, only 2 months had dispersion below 20. But during the beta trade, nearly 40% of months had the same level below 20. That's unbelievable. As volatility rises, that dispersion will rise with it. And we've started to see it. Volatility spikes have been so prevalent in the last 2 years that it equals the same number we saw over the previous 2 decades. Look, as active investors, as investors overall, we have to start getting our arms around the notion that the coming 5 years are going to be less about market returns and more about finding the winners and avoiding the losers. We've talked a great deal about this at AB, and there's a great deal more to come. But for now, thank you as always for joining, and we look forward to seeing you next quarter.